Hi, and good afternoon. I am Amy King, the National Sales Director for Management Services International. Welcome to our course titled Captive 2.0, You Own an Insurance Company, Now What? This class will be monitored, and CPAs who are participating for CPE credit will receive 1 credit for specialized knowledge upon completion. CPA participants are required to participate in our polling questions. Should you need verification that you completed this course, records of today's attendance are kept electronically and can be located by contacting us. Our contact info was included in your registration email. Upon completion of today's session, you will receive a few handouts, which will be a certificate of completion, a summary of today's key points, and an evaluation form. There will be time at the end for us to take your questions. To submit a question, you will write in the box on your screen. I will give the presenter your question to answer at the end. In addition, if you would like the course material, please notify me via email and I will share the slide deck. Please note, we have another online webinar. It is scheduled for November 5th or 2 p.m. Eastern that will last 50 minutes. This course is on non-qualified deferred compensation programs. We will discuss the advantages and hesitations for employers to offer this type of program to reward and retain key employees. If at any time you would like us to offer a session regarding captive insurance to your firm, to your clients, or to anyone you feel would benefit, please contact me to get that scheduled. We're going to give it a start here. So, today's course objectives. You need to, basically, at the end of this course, you will be able to understand the various management functions of running a captive insurance company, briefly explain how a captive insurance company operates once formed, and get my screen to work, understand a typical claim process, start to finish. When you complete this course, you will be able to suggest and briefly explain how a captive insurance company operates once formed, briefly explain the role of the captive insurance manager, and explain how a claim is processed. Today's topics will be the various functions of operating a captive, keys to a successful captive insurance company, and claims management. So who are we? We are Management Services International, otherwise known as MSI. We provide the finest expertise in creating and managing captives and non-qualified deferred compensation plans. We manage and form captives for a wide variety of companies that are small to mid-size. They are on and offshore, and we handle at minimum the compliance, reporting, underwriting, claims management, and financial management. MSI is one of the largest captive managers in the North Carolina area, or domicile rather. So today's presenter is Jeremy Kolumbic. He is a CPA and president and managing partner of MSI. He is an experienced and licensed CPA and a financial professional that has worked in captives for almost 15 years. He's a member of the Captive Insurance Companies Association, and he serves on the board of the North Carolina Captive Insurance Association. Jeremy recently stepped down, doing an extended term as the youngest ever appointed chairman for the North Carolina Captive Insurance Association. He frequently works with North Carolina Department of Insurance, with commissioners, congressmen, senators in Washington, D.C. on regulatory and compliance issues, especially issues regarding 831Bs and captive insurance companies in general. He's a sought-after speaker at national conferences and a published author for such publications like Captive Review and Captive.com, Captive Insurance Times, and other notable publications. So, today we are going to talk about you own an insurance company. So now what? I'm going to hand it over to Jeremy Kolumbic.
Thank you, Amy, for the introduction. So what we are going to be talking about today, and we'll start with first, is you own a captive, what should you expect? What you should expect is, look, first to understand what you should expect from a captive manager, you first have to understand there's many moving parts. One of those is regulatory compliance. Now, this is regulatory compliance when speaking about is not only just on the jurisdiction, that the captive is being formed, but also, let's say the captive is formed in the United States or formed offshore and elects to be taxed as a U.S. company, you also have the Internal Revenue Service, the IRS. Next, claims procedure. I'm going to be talking about this over and over and over today because it's extremely important. I'll be going through how the last two major court cases on small insurance companies affecting the 831Bs both addressed and had issues according to the court opinion regarding claims procedure. Because remember, you own a captive, it's an insurance company. Insurance companies are expected to have claims, which means you should have a claims procedure. Next, financial reporting. Now, this is financial reporting to the different types of jurisdictions as well, again, if you're in the United States, to the IRS. The jurisdictions will probably have a premium tax or they'll have also or request an annual certified audit. Next, if you're obviously owning a captive, you want to have shareholder statements. It's very important. You want to know how your captive is doing. You own it, it's an investment, how's it going? And the final piece of this will be a relationship management. And I actually view this as the most important key as part of these relationships, because it's not just a relationship with the captive owner and the manager. The captive manager acts as kind of the quarterback, which I'll go over that analogy in a second, for the whole team. So let's go on to managing a captive is expensive. So it's extensive to the point that it's not just the needs of the client, but there's also regulatory compliance or components, First, and most important, it's a business plan. Whenever you're filing a captive or even starting any type of business, you have to have a business plan. Business plan will have, well, what are you going to do? We're going to run an insurance company. Here's our pro forma of how we think we're going to perform as an insurance company. Now, this may be adjusted, obviously, based off of every year or every couple of years the business may change, but you have to have a business plan. You have to have actual reports with regulatory requirements. Again, you're an insurance company. Insurance companies just don't say, hey, you know what? You want $1 million of coverage? We think it's going to cost $100,000. Doesn't work that way. Just like with any type of insurance, you fill out a questionnaire, insurance questionnaire, gathers information, pass it on to an actuary to do an actuarial analysis to compare your profession or job or industry to other industries and the marketplace. Underwriting. Underwriting in the sense that not just claims, which will have underwriting, but also underwriting when you're issuing different policies in the insurance company. Full accounting, which means bookkeeping, reconciliation, monthly financial statements. Again, very, very important. You have yourself as the owner that you should be receiving this type of reporting, as well as monthly financial statements or reconciliations are much necessary because you want to make sure they're GAAP and they comply with what the jurisdiction is looking for. Prepare and manage premium tax returns. Now, most jurisdictions in the U.S., such as North Carolina, does request and require premium tax returns. Next, prepare and send out premium indication letters. Very, very important. Again, you're an insurance company. Insurance companies, if you have insurance coverages, they're going to send you a renewal notice. This is what you paid for last year. This is what the premiums are. Maybe there's a surplus because of a certain event that happened. Update declaratory pages. I always tell people a declaratory page is kind of a synopsis of your policy, right? You have a aggregate limit, you have what your premiums paid, kind of quick snapshot of what's going to cover. And then behind that, you have the details of the policy pages. And unfortunately, as I'll talk about later, a lot of people really don't read until there's a claim. And those can be updated for a few of the reasons. One, maybe the insurance company had to update their language. Maybe the policy's changed. Maybe there's a surplus on there. Compile investment reports. Again, you're an insurance company. Insurance companies have reserves. Those reserves can be invested. Manage claims. Probably the most important thing of an insurance company. Okay, because an insurance company builds into its premiums that there's going to be a profit. Remember, insurance companies are there to make money. So you want to make sure that claims are not only managed efficiently on your side, but also to make sure that the company's going to be as profitable as it can. Coordinate annual audits. This is part of the team approach. Now, even though the auditors are going to be independent, you still want to make sure that the manager has a good relationship with the audits and that information is getting timely presented to the audits so the auditors can adhere to deadline requirements that they have with the chosen jurisdiction. And one of the final things has to deal with the IRS tax forms. Now again, as you notice, IRS, we're talking about the United States. These forms would not be applicable if you were outside of the United States and not having to be taxed as a U.S. company. So an 1120 PC is a tax return used for an insurance company for captive. A 7004 is an extension for the insurance company to have it extended not from the due deadline. They're actually just due on October 15th, but the tax is obviously still due when the tax returns are originally due. 8832, material advisor. This has to do with the Notice 2016-66 that came out about a few years ago. And with this, the IRS came out and said if certain qualifications are met under the 831Bs, which has to do with small insurance companies, which I'll talk about a little bit later, then the advisor or advisors involved may have to fill out this form, or if they don't, there can be very heavy penalties. In addition to the Notice 2016-66, it also discussed the 8886 form, which is a transaction of interest. This has to do, again, if it's an 831B, so a small insurance company, and there's certain criteria that is met, the client that owns the captive, as well as different entities contributing to the premium, would have to fill out this form. So let's talk about teamwork. Teamwork is very, very, very important, as I mentioned before, not only just with the client, but as well as the team. Now, overseeing the captive, as I mentioned before, is like managing a football team, and you want to build the best team possible. So just like any type of owner of a team, they're going to try to hire the best management, which is the best captive manager, because that way, if they're seasoned, they'll have hopefully the best success in running the insurance company. Now, the manager, just like a team, is responsible for handling, implementing, and administrating the captive program. And the knowledge that this manager should bring should help make this kind of a turnkey type of approach. So what do I mean by expecting communication? Next slide, please. So expect communication. Now, business owners may not spend a lot of time thinking about a risk management program because they're concentrating on their primary business. This is why they're hiring a captive manager, just like when an owner of a football team hires a manager. Now, it's not uncommon for a business to think about insurance only before it's time to buy an insurance policy or submit a claim. So as I mentioned before, unfortunately, a lot of people don't think about the insurance they have until something's happened. And this is where a well-chosen captive manager makes all the difference. And the reason for that is the captive manager should have, and I'll go over this again throughout the communication, throughout this call this afternoon, constant communication with the captive owners to help achieve their business goals. Because their goals that they originally had will probably change over the course of time. And therefore, we can then adjust potentially their coverages, which will probably adjust their business goals. Next slide, please. So captive manager should be fully transparent in all communications and maintain a trusting and solid relationships with his team. And we're talking about the captive team here. What makes up the captive team? Well, we have lawyers, you have underwriters, you have certified public accountants, claims specialists, and yes, even regulators. Now, even though the regulators don't work, obviously, for the captive manager, the regulators, you should have a good relationship with the regulators. Now, an agile captive manager should be knowledgeable in all areas of the captive insurance industries with new developments, regulations, and requirements affecting the members or the shareholders of the captive team. Now, why is that? I jumbled that real quick. Well, it's not just the captive manager should be knowledgeable. It should be the whole team. Because the captive manager might hear about some update that one of the other people on the team has not heard about yet, and they can pass that information along. Same thing with, let's say, an actuary, and something was updated in the actuarial standards. We want to make sure, obviously, that that actuary should be passing that additional information on to the captive manager, and the captive manager should be passing it on to the owner of the captive. And that's what we talk about. They should not only be equipped with the latest information, they should keep their clients informed of the same. Again, I'm going to reiterate, constant communication, being well informed. That's what the owner of the captive is paying the manager for. So let's talk about some key successful captive. So, we've talked about so far, we have this captive. We know we should have constant communication. There's a lot of things to do to running the captive. What are some things that a captive owner should look at to make sure that they're being done, that their manager is doing? So basic accounting, bookkeeping. This should be done in running the business. Documentation involving activities, communication. Now, these are just 3 bullet points here. There's a lot of documentation involved. But again, big things. Your insurance company, premium indication letters, very, very important. Claim summaries. Okay. Now, this is extremely important, as well as claims procedures, because this relates to the 2 most recent court cases with the 831Bs that I was alluding to when I first started. The first one has to do with Avarami. The Avarami case, they ended up having claims that were submitted just as they were getting audited with the IRS. Now, that seems a little odd to start, but let's even say it's true. Well, they were also paying these claims without really going through a claims process. Well, as we're going to be going over today, 2 actual claims, one that was denied and one that's approved. Just because you own an insurance company, and if you submit in a claim, doesn't mean it's always approved. Let's say it doesn't apply to what the policy is submitted to. Then it shouldn't be approved. In claims procedure as well. This was gone over in not only the Avarami case, but Reserve Mechanical a little bit had the same things to do with there wasn't, according to the court's opinion, an adequate claims procedure. And then finally, corporate governance. Captives should invest reserves in reasonable investments. Again, I'm going to go back to the Avarami case because this was really pointed out in the court opinion. If you're an insurance company, you can't have the majority of all your investments in illiquid investments. If you're an insurance company, you should have to have liquidity to pay claims because you're an insurance company. That's the final point. Captives should hold a reasonable level of capital to pay large claims. So let's kind of go over again key successful captive. Be knowledgeable on external regulations and requirements. Have a claims manual. Very, very important. Have a claims process for either approving or denying claims. Because as a captive, which is an insurance company, some claims will probably get denied and some will get approved. And there might be adjustments on some claims. But just because you submit in a claim for the full value, there might be circumstances, which we're going to kind of go over today, one of our claims that was approved, that maybe the full amount was not paid and there's a reason behind that. Conducting annual reviews. This is annual reviews with your clients. Some of these are a lot more than annually. Okay? What I mean by this is obviously, and we'll talk about communication in a little bit, but the client, when you call somebody, you should be getting a response from your captive manager timely. And we'll discuss what I mean by timely a little bit. Sending premium indication letters and renewals, again, I'm saying this over and over and over again, you're an insurance company, you should act like an insurance company, and an insurance company will have premium renewals. Next slide, please. Know your filing deadlines. So a good way for this, if you own a captive, is the manager might sends you a calendar as part of the welcome packet. Here you go. You're welcome to this insurance company. Here's how you file claims to the left. Here are important dates that you should be well aware of as part of your insurance company that we're going to do for you. We talked about a lot of these already. One of them that we did talk about that briefly mentioned was an 831B election. This has to do with a U.S. insurance company that wants to be taxed as a small insurance company, because under the 831B election currently, the captive can receive up to $2.3 million per year without paying taxes on those premium dollars received. Another one we're talking about is the 953D. Now, the 953D has to deal with a company that was formed offshore but wants to be taxed as a U.S. company to avoid the control foreign corp rules. Next slide, please. So, some final things really for key successful captive program. Documentation is key. What we're talking about here is some of these were mentioned in some of the previous court cases. There was unexecuted contracts. You want to have executed contracts if you're an insurance company. Policy delivered after binders. Final actuarial studies not provided timely. This is really important, people. If you're an insurance company, your actuarial shouldn't be provided a year or so later. A couple months maybe, because they're doing just like any type of underwriting, but not a year or so later. We have investment earnings do not agree to statements, and 1099 dividends, and 1096 and FBARs and FACTAs. This again just has to do with more with documentation. So let's talk about expect accessibility with your manager if you own a captive. Now, as I talked about earlier, you want to have proper communication in place, and you should expect that with your captive manager. And what did I say earlier? What I said earlier was you should get a timely response within 24 hours. Now, it does not mean your manager will have what you're looking for within 24 hours, but the firm should get back to you 24 hours saying that we're processing your request for whatever it is. Okay? And this may take a business day or 2 business days or a week, but the management firm should get back to you and tell you how long it is. Next slide, please. Now, this accessibility does not mean that you should only expect the inbound communication, which means that if you're the owner, that, oh, I only talk to my captive manager when I call him. No, the manager should also be reaching out to you, whether it's monthly, quarterly, or annually. Really doesn't matter. Sometimes captive managers talk to more clients more often, not only because the client's engaging, but the management firm does this as a practice. So what do they do what do most experienced captive managers do? They send out a newsletter. Now, these newsletters should at least be annually, but a lot of times it provides updates, okay? Updates on, here's what's going on in the industry. There were these types of cases. This is what's happening. This is how this will not affect the captive program, or this may affect the captive program, or based off of additional regulations or jurisdictions or whatever it may be, we might be doing additional updates in order to follow the law. Next slide, please. A captive manager should be proactive versus reactive. Now, what do I mean by this? A captive is an insurance company and must be operating as such. Okay? So in order to meet their clients' goals, they should be up, again, as I stated earlier, on all the regulations between if it's the jurisdictions or states and how to comply with those. And as I mentioned earlier, it's imperative that your captive manager stays up on these regulations as well as the overall larger insurance industry. Next slide, please. So again, I know a lot of these are redundant in a sense, but I'm always a big fan of hearing things repetitively because they're very, very important. Now, a well-informed and nimble captive manager will assess how changes will affect your program and act accordingly. Okay? That means that if something happens They're not just waiting. Okay, let me go one more time. Something happens in the captive industry, let's say a court case, and they review the court case, and the court case says, you know what, we're looking at, let's say, more claims. Captive manager will generally look at this, review their claims procedure and process, and see if there's any type of change that may be needed just to tighten things up to make sure of that. Now, in conjunction with this, a proactive captive manager will plan accordingly. That means they will not do it the last minute. If something has to change in your policy, what they'll do is they'll say, you know what, so-and-so, starting January 1st of the following year, we're going to implement this procedure, and this is the reason why. Next slide, please. Okay, so as I stated earlier, the captive manager should keep the clients informed. Okay, informed on what? Well, when a captive is formed, an insurance policy is issued, there should be a claims procedure. So this is almost like a welcome kit. Okay, I talked about it real briefly before, but something that we've used, and we see a lot of captive managers that have used this, is you get a welcome packet that gives you copies of information, gives you a claims procedure. If you have a claim, please follow the following steps. This is the way our process works. Here are the captive deadline dates. Because at the end of the day, the captive manager is the one who's ultimately responsible for ensuring that the captive follows all the applicable rules and regulations. Next slide, please. So with a well-informed and transparent process to adhere to all pertinent, totally butchered that lines. Basically, in order to achieve positive results, you want to make sure that you have a transparent process to adhere to, okay? And while each captive program's goals and outcomes will vary, it depends really on the reason for the captive, okay? There might be going towards more of a workers' comp, okay, or more to a general liability for the types of coverages. You can want to develop that in the early stages of this captive, things will probably change. And it's up to the captive manager, as well as the client, but more to the captive manager, to keep constant communication with the client or clients to make sure that all the goals that they're trying to seek are getting met. And with that, I think we have our first polling question.
We do. So we offer these classes to CPAs and financial advisors and anyone who feels that they would be of a benefit to knowing this information. In order to stay compliant, of course, we have to have these wonderful polling questions. So I'm about to launch a polling question right now that if you are a CPA, please go ahead and answer this question. If you are an insurance company, you are what? We tried to make these polling questions very easy on you. So it's not too difficult. We'll just give it a couple more minutes here. It looks like most of the people have easily answered this question. And so I'm going to go ahead and finish up and close the poll. I will let you guys see the results. So if you own a captive, you own an insurance company. And therefore, you should be operating as such.
Well, great. Well, I believe we're going to move on to how a claim works. So if you pull that up for us, Amy, I'd appreciate it.
Yep. Does it come up? You know
how
these polls always get me. These polls and I are just not the best of friends here. So should be sharing the results. Are you seeing those sharing poll results screen? And closing that, and might have to do your little trick where you give me the controls back, Jeremy.
Okay. Switch it here. Let me switch it back to you here. Let's try that.
One thing we've learned in offering these classes is we've become very technically savvy, I will say. So.
Yeah, you gotta love technology, everyone. Okay, so let's get back. Really important how a claim works, because as I've mentioned, the two recent cases many times at this point, Reserve Mechanical as well as Averami, a big thing that the court was looking at was claims. So how does a claim work? Well, again, with any type of captive, it's an insurance company, they're expected to obviously have claims because they're an insurance company, which is why they build up reserves for these types of claims. So there should be a claims process or procedure in there, and they are expecting to pay claims. So let's look at insurance risk pooling. So claims will be charged as the following. So you see here in the first two, it says 50% of claim will be charged, to the CHIC or captive. CHIC is an acronym, means closely held insurance company. It's the same thing as a captive. Unfortunately, in the industry, there's a lot of different acronyms, and it can get quite confusing. 50% of the claim will be charged to the pool to the extent of the cash in the pool for the policy year. So what does that mean? It's a lot of info, so to speak. Why is there 50%? Well, the IRS has a safe harbor rule that they came out with that said if 50% of a person's premiums, this company's premiums, is at risk, at least a minimum of 7 different people or more, then that will be sufficient for risk shifting and risk distribution. So that's what our firm uses, and a lot of firms use that. But that's the IRS, the safe harbor rule. The court's around 29.6. But for our examples, we're going to go over today, we're going to use 50%. So what does that mean? That means if you are the owner, if you have a client that's in the captive, and they pay, let's say, $100,000 to a captive, that means $50,000 if they file the claim, be charged immediately to their captive, as well as $50,000 of that will be subject to part of the pool. Okay, we're going to go over an example of how that works. And pool claims in excess of the pool's cash, if any, will be charged directly to each captive based off their pro rata share of the pool's risk. So what does that mean? What that means is a seeding or fronts company, which we'll talk about, which is a fancy term for the company that writes the paper, a lot of times act as a pool to pool the risk together, because you just can't insure your own risk or you're not really an insurance company. So what happens is these insurance companies that are pooling this cash together might release so much funds, and what they're saying here is if you go past that funds that they release, they're going to look towards the captive that your client or clients own for their share of the pro rata risk. So let's go over, again, some more information here. Let's give kind of an example after this. Pool's policy period ends December 30th, the calendar year following policy year, i.e. 2017 policy year will expire December 30th, 2018. That means that the policy year starts December 31st, 2017. It will expire December 30th of 2018. It's kind of a one-year policy. Final 25% premium to be remitted by March 30th, 2019, net of pool claims. So where does that 25% come from? That's what we do on our type of captives. You'll have different managers hold back X amount of cash in the pooled insurance companies. It's the insurance companies that everybody's pooling, depending on the claims history. Because why aren't we releasing 100% immediately? Well, this is an insurance company, the seeding or fronting company, the company writing the paper. You have to make sure there's enough funds available to pay claims. So let's see what a picture looks like. Next slide, please. This is a kind of similar or typical structure you may see in a captive. The insured's your client, right? They have their business. Well, they're paying their premiums to a seeding or fronting company writing the paper. It's also asking to pool everybody's coverages together. Now, let's say you have 10 different people. They're all paying the seeding or fronting company, and they all own their own reinsurance or captive company. So what happens? Well, when the money comes into the seeding company, and again, we're going to be using the 50% here. If 50% of the risk is your clients, that means your clients will receive 50% of the premiums. And that means the seating and fronting company will hold on to 50% of the premiums to start. And let's say after a given period of time, say 90 days or 120 days, whatever the captive manager thinks is reasonable, they will release half of those funds held by the seating or fronting company if there's not any type of excessive claims that they view will go through that portion. And then they will hold on to that final 25%. And so all the policies and all the seating and fronting companies have expired and generally give about 30 to 60 days to close out any claims and send the rest of those funds minus any seating commissions to the captive. What is a seating commission? Okay, seating commission is just a fee for pooling your risk in part of this pool. Next slide, please. So I told you I was going to go over a claim. Let's go over a claim that was denied. This is very important. So first, the claim recipient with all supporting documentation fills out an initial claim notification form. As you see up here at top right, it's for directors and officers liability. They send it to the third-party underwriter for analysis. So what happens really is the claim recipient will send it to the captive management firm. The captive management firm, like we do, we might have a person and working at a firm that underwrites it, then we'll push it to a third-party underwriter for analysis. So let's read about this one. This happened in August 2017. We obviously changed the address and contact name for confidentiality purposes, but a lot of this information is exactly what happened. This company is called Pools R Us, sold and designed a pool for a customer. The client says, I approved the design and sent it to permit. However, after we started building the pool, we found out that the arbor that is part of our contract can't be built the way it was designed. The arbor was designed to close to the property line. The city has set back requirements, so the arbor needs to move about 3 feet further away from the property line. The homeowner does not like the idea of moving the arbor because it changes the look of how the arbor and pool go together. The homeowner wants to sue us. However, the homeowner will let us redesign the arbor if we pay them $21,500 for their time, trouble, and time delays. The time delay is about 4 to 6 weeks, 4 to 6 weeks of them not being able to use their pool. Please look to see if this is covered under any of my policies, things changed out. So just a couple of things. First, this has nothing to do with directors and officers liability, but unfortunately a lot of clients, whether in their captive or not, don't necessarily read through all their different insurance policies. So this client was trying to submit this in to see if this was covered. On review, our claims analyst made the following recommendation. I cannot see if there's any policy coverage that would pick up what has been outlined. Even if the customer proceeded down the route of suing the company, there's no commercial legal expense coverage in place to pay the cost. So in this realm, the client does not have the proper coverage in the captive, and it looks like not even on the commercial lines. It says the matter itself looks to fall more under an act, errors and omissions on the part of Pools R Us in the design and layout of the pool and the location of the arbor within the contract with an apparent omission on their part with regards to the rules and regulations applicable to local planning requirements. If Pools R Us is designing and installing pools and adjacent landscaping, I would anticipate that they would have a professional indemnity, which is an errors and omission type of liability. So what happened? We received the final outcome after a thorough analysis, and we provided the client saying, unfortunately, your claim is denied because of the following reasons. Now let's go through one that was approved. But again, it was approved with a slight modification. Let's go over why. Again, same type of procedure report here. We have a claims form that was filled out with so much pertinent information. It was reviewed and sent to the third-party underwriter. Now, this happened in October 2012. Business interruption insurance, very type of popular coverage in a captive. This had to deal with Hurricane Sandy. It forced New Jersey to declare a state of emergency on October 28, 2012. The town where our office is located, Medford, lost 4 hours on October 29, 2012, 8 hours on October 30, 2012, and 8 hours on October 31st, 2012. All utilities, water, electric, and gas, were inoperable, making the dental office non-functional. The total loss of production and recollections were $37,500. Now, also, what you can't see here, these are all going to be signed and dated. These are not signed dated because we made a copy. We had to kind of imprint some of the information out, but they will be signed and dated for your client because they have to adhere to that they're providing all the information that's accurate. So the claim analyst reviewed and said, following our claim review and supporting financial patient booking documentation. So this was additional information which will happen not only in the captive but also in the commercial lines, that the claims analyst, underwriter, will ask for additional information if they think it's necessary. Submitted in respect of the closure and subsequent loss of income for the operating location, our recommendation would be to settle the submitted claims as follows. Okay, so the client submitted $37,500. We want to subtract 20% for rebooking clients and $1,000 for deductibles. Recommended settlement offer $29,000. Why was there a 20% deduction for rebooking clients? Well, that's why that's what the underwriter asked for patient booking documentation, because just because someone has a loss that day, especially as dentist, doesn't mean they're going to lose the income for the rest of the year. The clients are probably going to rebook. As such, after reviewing the information, that is why that reduction was recommended. So we provided the client with the recommendation, approved that result, and dispersed the amount of money stipulated by the coverage. So let's go over how a claim flow would work. Here's the following. And once you click one more down there, Amy. There we go. So you submitted a claim, let's say, for $300,000. Now we're going to make some examples here. What I mean by this is, let's say everybody paid the same amount of premium. That's why all these numbers will be the same. Okay, so everybody pays the same amount of premium to the captive. It could be $1 million, okay? Because if it's not the same, each different type of entity in the pool would have a different amount of exposure. So how would a $300,000 claim work? Let's say they filed the claim procedure. Let's say they submit all the proper documentation, went to the claim specialist. Claim specialist says this is completely valid. After the deductible, it's $300,000 that has to be paid. Well, $300,000, this is what you would owe if you own your own captive, or what your client would owe. $150,000 if your client's the one who submitted the claim. Since he has half the risk, he would have half the amount due, $150,000. The other $150,000, let's say there's 10 people that again are all in the same pool, that all pay the same premiums, would each be subject to $15,000, which would include your client. So out of this $300,000 claim that would be paid by that seeding or fronting company right in the paper, $165,000 would come out of your client's reinsurance company. And I believe with that, Amy, I think we're on poll question number 2.
Yes, sir. So we'll see if my technical capabilities work here. So it's a pretty easy question. As I mentioned, we try to go real easy on you. If you are an insurance company, you should expect to process claims. True or false? Give it a couple minutes here for everyone to vote. I think someone's just trying to be funny here when they're voting false, but maybe. Hopefully everyone gets this correct. We're looking for 100% participation, 100% correct answers, and looks like we're almost done. So we have close to 100% participation, so I'll go ahead and close the poll since we're nearing on our time ending here, and that way we can wrap up and talk about the post-captive solution. Let me share this. So pretty much everybody got it correct. It is true. Can you see my screen, Jeremy?
I can, but it's still on the polling question. We have through polling.
Okay.
Yep, polling question. There we go. Hey, this is good right now.
All right.
Okay. Well, I'm going to leave everyone. This is the final slide I want to show everyone. And even though we were talking about what you should expect from your captive manager today, we went through a claims, how it works, claims process, what you expect, and expect communication. I always like to leave people with why your client initially or yourself, if you're a client, you're on this call today, why you got into the captive. And look at the comparison of why a captive solution, if done for the right purpose, is so powerful to clients. There's a profit center. There's reducing commercial insurance premiums, better management of risk. This has to do with potentially plugging exclusions or gaps in those commercial policies, increasing risk awareness, which is just educating, yourself if you're the business owner or your clients. If you're on here just looking at this to advise your clients on about maybe some coverages that they were not aware of, the severity they weren't aware of. And finally, yes, the tax benefits, which are more prevalent under the 831B, which again has to do with small insurance companies in the United States that can receive the $2.3 million per year without paying taxes on those premium dollars received. And with that, I think we have our final polling question.
Yes. So again, per regulation, we have to launch just one more poll. Wasn't trying to make it hard for you guys, but just trying to review the benefits of a captive. So I'm going to launch that for you right now and see if everyone knows how many benefits there are to having a captive insurance company. And so far, I don't see any questions that have been posed to our speaker, Jeremy Kolumbic, today. So please keep in mind that if you do have any questions or any other information, feedback, anything else that you would like to discuss with us, you have my email. We are here for you. This is a very busy time. The end of year, everyone is looking for a great end of year solution, which we believe captives are just that. And for those that already have a captive insurance company in place, we're happy to help you hopefully understand what you should be looking for from your captive manager. So hopefully you got that out of today's call. It looks like everybody has pretty much participated, so I'm going to go ahead and share the results. But yes, all of the above, these are great benefits of having a captive. And that concludes today's session. So I'll go ahead and launch the handouts. And I think we're pretty much right on time, Jeremy. So good job.
Great. Well, again, I hope everyone learned a lot. We do have another course, not on captives, on non-qualified deferred comps, but if there's anything else that you'd like to see from us in our future presentations on captive 2.0 or even our 1.0 class that we had about a month ago, please email Amy out, and I hope everyone has a good rest of the weekend that's coming up.
Thank you so much. Thanks a lot.